Hey guys, it's been a while since I presented to you a new lender. Typically, you see the same faces on my channel over and over again. Usually, there is a reason for it. But I found some very interesting lenders recently, and one of them I really want to introduce you today. That lender have the potential and had a loan product that might help you, some of you who are flippers and have flips that are on the market, and also some self-employed people with very interesting product that I've never heard about before. So without further ado, let me just go ahead and introduce Arin to you. Arin, go ahead and say a couple of words about yourself.
Of course. Hi, everyone. My name's Arin. I'm the president of United Trust Mortgage, founded just a couple months ago, but I've been in the industry for about 10 years now. My goal is to say yes to a majority of the unique scenarios out there. And more often than not, I come across unique income situations that kind of falls outside the box of typical guidelines, where we're able to go ahead and provide specialized products and services to be able to go ahead and get you guys to the finish line.
Perfect. So let's jump into your presentation because we just teased a very special product and I cannot wait for you to let them know.
Of course.
Go ahead.
Right. Yeah.
Go ahead.
So
Mhm.
so we have what's called non-QM products, which essentially fall outside your typical underwriting requirements that you come across your typical national lenders, let's say, for example, your Wells Fargo's, your Chase, your Citibanks, where they have very vanilla products. The non-QM product is still considered a conventional loan, but it's backed by private investors, allowing us to underwrite to unique income scenarios. We'll start with the profit and loss loan, the P&L only loan. And this mortgage option is designed for self-employed borrowers and requires only a profit and loss statement. Couple quick requirements that we'll go over. You need to own at least 25% of the business, be in that same business for at least 1 year, and must have at least 2 years of experience in that same industry. A profit and loss can be utilized from separate businesses. I know a lot of business owners will dabble into different industries and bring in multiple sources of income. The beautiful thing about this product is that we don't need any tax returns, no bank statements, or no tax transcripts. So the documentation requirement is very easy, super seamless, and allows us to go ahead and maximize the amount of income we can use to qualify you for the loan. Some of the different requirements that we'll need to go ahead and check off would be really just a CPA letter and a CPA, or really just a tax professional, so to speak, to go ahead and sign off on the profit and loss statement. So either a CPA, an IRS enrolled agent, a CTEC, a PTIN, or a tax attorney. So all of them would ultimately qualify. We would need a profit and loss statement covering the most recent 12 or 24 months. 24 months will give us just slightly better pricing on the loan, but not that big of a difference. Some of the different loan features that are available is a max loan to value of 80%. These programs are available on owner-occupied properties, second homes, as well as investment properties. They're available for cash out as well as rate and term. So if you own a property that's free and clear and you want to go ahead and access the equity to invest into your business or open a new business, this is a very suitable product for that. Minimum FICO requirement is going to be 680 with loan amounts up to 4 million. Income calculation is pretty straightforward. We take the net income from the profit and loss statement and divide it by either 12 or 24 months, and we multiply it by the borrower's ownership stake. Some things that we add back to the calculation would be depreciation, depletion, and amortization, because those aren't actual costs. That's not money coming out of your pocket. Therefore, we're able to add that back to the calculation. Industry standards apply. What do we mean by that? Let's say, for example, you're a general contractor and you show us a profit and loss statement with $250,000 worth of gross income, but only $20,000 worth of expenses, right? As a contractor, we're pretty sure that your expenses over the course of the year are going to be a lot higher than just $20,000, right? So it does have to make sense to the underwriter, and on case by case situations, the underwriter may request additional documentation. Now, There's a difference between the P&L only loan and a standard P&L loan. So the standard P&L loan will be accompanied with tax returns as well as bank statements to go ahead and verify current receipt of income. The P&L only loan, again, less documentation needed. We don't need the tax returns. We don't need any tax transcripts. So let's say, for example, you made a killing in 2024. 2023 wasn't all that great, and you haven't filed your 24 taxes yet, but you have a profit and loss statement, right? That's where the P&L only loan will come into play because you haven't filed your taxes for 24 yet, but we're able to go ahead and utilize the income for that year specifically. Less scrutiny on these programs. So since we don't need bank statements, since we don't need any proof of current receipt, we're not really analyzing any irregularities in cash flow, and the underwriter is questioning less information once we submit the documentation. And one of my mottos is less is more, right? The less we go and provide to the underwriter, the less information they're going to have us go ahead and verify and clarify, the easier your loan process is going to be. The standard P&L loan allows for up to, again, $4 million, larger loan amounts, a little bit more lenient when it comes to your loan to value. You can come in with as little as 15% down versus your typical 20, and you get better terms. Slightly better interest rate, but it's not a landslide of a difference. Next is going to be the bank statement loan. So again, this is a program that is utilized for self-employed borrowers, and it utilizes the bank statements to verify income. Same concept as the P&L only loan, no need for tax returns, no need for tax transcripts. You have to own at least 25% of the business, be in the same business for at least 1 year, and be in the same industry for at least 2. Bank statement loans allow up to a 90% loan to value, so less money down or a little bit more access to equity. Lesser FICO requirement of 640, loan amounts up to 4 million. Qualifying income calculation will ultimately take the deposits over the past 12 months, multiply it by a 50% expense factor, and divide that by 12, right? So let's say, for example, you make $240,000 a year, or you have $240,000 worth of deposits in your bank. We'll take 50% of that to account for expenses and divide that remaining $120,000 by 12 months. So your effective income in that case would be $10,000 per month. Now, the expense factor can be decreased with a CPA letter. So if you're in a business or industry that doesn't have a significant amount of expenses, we can go ahead and decrease that expense factor and increase the amount of income that we can utilize. Now, the P&L loan versus a bank statement loan. So if your business is profitable, but your cash flow fluctuates due to, let's say, seasonality or investments, or maybe any other reasons, the P&L loan is beneficial because it focuses on overall profitability rather than daily bank balances. If your bank account has significant fluctuations, negative balances, irregularities, the P&L loan will be preferred because it won't require a detailed analysis of your bank statements. And again, just less questioning from the underwriter. Again, less is more. Bank statement loans are suitable for those self-employed individuals who have strong and consistent cash flow, but haven't been profitable, right? Due to maybe high startup costs or reinvestment into the business. They typically have a little more relaxed credit requirements and financial documentation requirements. Again, we can go up to 90% loan to value with a 640 credit score. And again, it allows you to qualify for higher loan amounts relative to a P&L loan. Last but not least is going to be the written verification of employment program. This isn't necessarily going to be designed for business owners, but those with high income earnings who can't really verify their income. So what do I mean by that? Let's say a construction worker or a contractor who gets paid cash, traveling nurses with variable hours, that can't check off the consistency and stability box that most underwriters are looking for. Or let's say a server who makes most of their money through tip income. So in this case, all we need is just what's called a written verification of employment that your employer will fill out, sign off on, and send back to us. There's no need for pay stubs, W-2s, or tax returns. Up to 90% loan to value, so as little as 10% down. And the only caveat is that you have to be with your same employer for 2 years or longer. Now, there's also an FHA, written verification of employment program as well. This allows for as little as 3.5% down. And again, same concept here as before. If you're receiving cash income and can't really verify it with pay stubs or W-2s, and you want to come in with a lower down payment, this will be a suitable product for you. Now, if you need a CPA contact, you can reach out to my colleague and my brother-in-law, Emin Hartunian. You could reach him at the phone number or email provided, or you could just reach out to me directly, and I'm more than happy to make an introduction. Thanks a lot. Appreciate the time, and let me know if you have any questions about what we've talked about so far.
I
Elena, I think
actually
you are
do have
muted.
some questions. If you don't
Yeah.
mind, can we go into a Q&A session?
Yeah, absolutely.
Okay, so can you scroll back to the P&L? I want to see, so let's just say that we have an LLC and there's 3 partners on an LLC.
Mhm.
But the LLC been in existence only for 7 months. We have to wait 3 months before we can file, correct?
You would have to wait until the business has been in or operating for at least 1 year. Yeah, correct.
Now, out of 3 partners, only one has 2 more years of experience, and 2 others maybe he the flipper and they're more on the financing side. How would that work?
That's a great question. We would utilize the P&L just for the partner that's been in that same business for 2 years. We can still add the other 2 partners to the loan if they wish to be on it, but we won't use their income.
Gotcha. So there could be a loan in which the LLC, even though it's an LLC, is written on one partner, not on all of them, correct?
Correct.
Okay, then second question, in the LLC, let's just continue with our scenario of 3 partners in LLC. Only one partner has a 640, or I'm so sorry, 680. What was the requirement for that? Can you scroll to the next page?
Yes.
There was a loan to value. Where was the, okay, 680. So let's just say one partner has 700 and the second partner has 640 and so on. How would we decide? And let's just say that partner is the one who has the experience, right? So we're just going to use, is it okay if we use just his FICO score, or is it an averageable partner? So how it works?
Great question. So we utilize the FICO of the primary income earner.
Okay.
Yeah.
So if it's an LLC, how do you, I guess it will be the question to the underwriters. How do they determine who the primary income earner, correct?
Correct. Yeah. It's essentially who makes the most money out of all of them.
Wait, personal on a personal level or on a business level for the LLC?
On a personal level, because they're
On a
taking a
personal
portion out
level.
of the business. So if
So
let's say you
basically,
have
is that a self-guarantee loan, or no? It's not a self-guarantee loan, right? It's not personal guarantee loan. It's a it's still a collateralized loan, but we're still looking at that person's personal, even though it's an LLC, we're looking into his personal income, correct?
Great question. Yeah. So it gets vested in the LLC, but the borrowers are the personal guarantors.
So wait a second. So can you explain vested versus the borrowers?
Yeah. So the title would appear on the so the LLC would appear on the title, but the loan itself would appear on the borrower's credit.
So basically, it would affect his or her loan to his or her what do you call it, debt to income, right?
Correct.
Gotcha. Okay, that was for the P&L loan. And you said that, can you go back to the slide where it's P&L only versus P&L standard? So on that one, on a P&L only, so it looks like it's a much, as long as you have 80% a loan to value, it looks like P&L only is a better way to go. Is there a reason to go with standard if you have 20% down?
If you're penny pinching and you really want a slightly lower interest rate and go through the additional documentation requirements and jump through those hoops, that's really the only reason why you'd want to go with the standard P&L. Plus, it gives you a little bit more wiggle room as far as the loan to value goes. So you could go up to 85% loan to value versus 80%.
But given that in both cases we're doing 80% loan to value, the only reason to go with a standard would be a penny pinching situation.
Correct.
Understood. Okay. In the bank statement loan, let's go ahead and go to the bank statement loan. So if my expenses, let's just say I declare my expenses in my income, right? If my expenses are higher, let's just say my expenses are 65%, and you can clearly see it on my bank account. Will the underwriter still use only 50% calculation for the expenses?
Great question. 50% is the standard.
Okay, so even if my expenses are higher, like we can see it in the document, they're still going to go with 50%.
Correct.
That's pretty good. In the written verification of employment, okay, let's scooch over to that one. On this one, so this one, the standard written verification of employment, self-employed people can use it, correct?
No, this would be for somebody who would be W-2'd.
So this would be a W-2 situation.
Correct.
Okay.
Yeah, this would be W.
Okay, those are all the questions. Okay, guys, if you have additional questions, you feel free to ask it in the comments. Also, would you be so kind, Arin, and scroll back to the first slide on where we can see your name and your contact information. So if you are intrigued by any of those loan options, and feel free to contact Arin and see if your situation will fit. Now, let me run this idea by you. Let's just say that I am a flipper and I would like to refinance the property that I flipped. For whatever reason, I don't think the market is right to sell the property this time. I want to refinance the property into a long-term rental. Which of those products would you recommend for me?
DSCR loan.
Just DSCR loan, straight up DSCR loan?
Yeah, straight up DSCR loan, that would be our first option. And if for whatever reason the DSCR loan doesn't work out, which is a rare instance, if we have the equity in the property, then we would flip over to a profit and loss loan. The nice thing about a DSCR loan is that if you have at least 30% equity in the property, we typically don't even need any ratios, meaning that most DSCR loans require a 1-to-1 ratio where you need to have the monthly income match with, at the very least, a mortgage payment. But if you have enough equity in the property or if you're putting enough money down, we can go with a no ratio program. The trade-off is just a slightly higher interest rate.
That's interesting. So is that just your underwriters, or is it for all DSCR loans? That's the first time I hear something like that.
It depends on the investor. So as a broker, I'm not a direct lender. I don't underwrite my own loans. I don't fund my own loans. I send them out to wholesale lenders. So kind of think of it like this. Like, let's say you're a flooring contractor and you have a wholesale outlet that you pick up floors from. That wholesaler isn't going to sell floors to the public, right? It's not open to the public. It's only available for licensed individuals. Brokers operate the same way, where we have access to wholesale lenders that won't typically provide their products to the public, but they'll provide them to brokers to be able to provide to their clients. So it just depends on the investor and what their guidelines are and what they're willing to do.
But you have access to multiple of them, right?
Yeah, as of right now, I'm signed up with about, I want to say 20 plus investors, and I'm adding extra ones every single week.
Gotcha. Any of them want to do private money loans? Just asking.
I have an investor that does private money, like hard money.
No, private money is slightly different. So private money can sometimes go in the second position, and hard money is always in the first position.
Got it. That's a good one. I can find out.
So if you can find people who can do in second position, there's a big demand for second position loans.
Second position, private money. Got it. Okay.
Yeah.
I have an investor who's coming out with a second position DSCR loan,
Uh-huh.
but they said it was going to roll out a week ago. and it hasn't yet. So I'm assuming that they're just probably going through all the
And in that situation, the only way he could do second position DSCR loan is if the first position lender allowed it, right? Unless he's both in the second and the first position.
correct.
Yeah, very good. That's wonderful. If you do have that guy roll out his program, please let me know, because
Absolutely.
right now it's more or less like word of mouth type of people, you know, whom you
Mhm.
heard about, and then you contact them, see if they can help it. But having an actual streamlined process would really help a lot.
Absolutely.
That's all I have for right now. So guys, those are, and if you want to, let's go ahead and recap. So we had a profit and loss statement, a profit and loss loan, which were two types of profit and loss loan. Then we had a bank statement loan, and then we had the written verification of employment loan. And as you can see, all of them are kind of targeting people with non-standard or unique income. So if you have questions to Arin, his contact information is 818-447-0735, and I will just give you kind of a little bit of my story. So I got introduced to Arin because he was a lender on one of the transactions that was failing and thinking fast on one of the properties that I was representing. And Arin came in within 7 days of closing, took over a problem loan, and closed us in 7 days. And it was a difficult underwriting situation too. So from a standpoint of me letting you know that Arin knows what he's talking about and he's not going to BS you, I vouch for Arin at this point.
Thank you.
Alrighty, well, that's all we have for today. Feel free to contact him. Feel free to post your comments in the comment section, and I will see you guys at the next video. Thank you so much, and
Thank you so much, Elena. I appreciate you all.